In the middle of the 17th century, long before the sound of shouting brokers filled the air, a wooden wall stood on the edge of a small Dutch settlement called New Amsterdam. That wall was built to keep danger out, but in time, it would become the name of the most powerful street in the world, Wall Street. Back then, the land that would become Manhattan was not a city of wealth. It was a wild, uneven place of dirt paths and wind-beaten houses. The Dutch West India Company had claimed it for trade, not glory. They called it a place of business, where beaver pelts and timbers moved from one hand to another. The wall, built in 1653, was meant to defend the settlers from potential attacks by native tribes and rival European powers. It stretched about half a mile, made of rough logs and clay, a simple barrier that whispered of fear more than strength. As time passed, that wall became more than a defense line. It became a border between two ways of life, the inside, where merchants gathered, and the outside, where uncertainty reigned. Each day, traders gathered near the base of that wall to bargain, barter, and argue. They traded not only goods, but trust. These small exchanges planted the first seeds of organized finance in the New World. By 1664, the English had seized New Amsterdam from the Dutch, renaming it New York after the Duke of York. The wall remained, though its meaning began to change. Under English control, trade grew more structured, and merchants started to think bigger. They began issuing promissory notes, lending money, and discussing ventures that reached across the Atlantic. A system of trade was turning into a system of finance. The wall was eventually torn down in 1699. Its wood, old and splintered, was used for other buildings, but the name Wall Street stayed. It had already become part of the city's pulse. On that narrow dirt path, merchants began to see that wealth could be built not just by holding goods, but by moving money. They understood that profit could come from paper promises as much as from ships and cargo. By the early 1700s, Wall Street was growing into a meeting ground for ambitious men. Taverns became offices, and coffee houses became trading posts. Merchants discussed insurance for ships, bonds for city projects, and shares in trading companies. The financial instinct was alive, raw, restless, and ready to expand. Among them were figures whose names are rarely remembered today. Isaac Moses, one of the early Jewish merchants, helped build trust in lending at a time when such practices were risky. Another man, William Duer, dabbled in speculation that would later echo through Wall Street's future crises. They weren't famous yet, but their actions built the foundation for the culture that would later define the street: ambition, risk, and a hunger for growth. Yet, not all was fair or clean. The trade depended on systems tied to slavery. Ships carrying enslaved Africans were insured by New York merchants. Profits from plantations found their way into Wall Street transactions. This dark connection remained buried under the success stories of commerce, but was part of the reality that powered the early market. It is a truth, often left out of cheerful accounts, but one that must be remembered to understand the full picture. By the mid-1700s, Wall Street had already become the center of public life in New York. The first city hall stood there, a grand building that hosted markets and political gatherings. It was under its roof that George Washington took the oath as the first president of the United States in 1789. The building was later renamed Federal Hall, and Wall Street became not just a place of trade, but a symbol of American power. But power always brings change and challenges. The merchants who once gathered to trade furs were now dealing in government debt, bonds, and shares. The line between honest business and risky speculation began to blur. As the 18th century closed, tensions over money, trust, and control began to grow. Wall Street was about to change again, and this time, forever. By the end of the 18th century,
Wall Street was no longer a dusty lane beside a wooden barrier. It had become the beating heart of a young nation's ambition. The United States was still new, fragile, and filled with financial uncertainty. War debts, unstable currencies, and distrust between states made trade difficult. Yet, within this struggle, a small group of men saw opportunity, not in farming or manufacturing, but in managing the flow of money itself. It all began under a buttonwood tree. On May 17, 1792, 24 stockbrokers gathered beneath a large sycamore tree on Wall Street. The air was still and heavy, but what they signed that day would stir the American economy for centuries. It was called the Buttonwood Agreement. Its goal was simple: to bring order to chaos. Before this agreement, traders often cheated or manipulated prices. Deals were made with rumors, and trust was rare. The men under that tree promised to trade only with one another and to set fixed commission rates. Their names, Leonard Bleecker, Hugh Smith, and others, are rarely spoken today, but their decision formed the foundation of what would become the New York Stock Exchange. It wasn't glamorous then. They worked in small offices or coffee houses, recording transactions by hand. But through that system, they brought stability to a growing nation's finances. The United States government had recently issued bonds to repay Revolutionary War debts. Those bonds became the first major instruments traded on Wall Street. Investors could buy and sell them, earning money based on government trust. This practice tied the fate of Wall Street directly to the fate of the country. When the government succeeded, investors prospered. When it faltered, panic spread through the narrow street. At the center of this transformation stood Alexander Hamilton, the first Secretary of the Treasury. His vision reshaped American finance. Hamilton believed that economic strength would make the nation independent and respected. He proposed the creation of a national bank and encouraged trade in government securities to establish public credit. Many feared his plan. Some saw it as favoring wealthy elites or foreign investors, but Hamilton pushed forward. He argued that trust in the government's financial system would attract capital and allow the nation to grow. His ideas laid the groundwork for Wall Street's power and its controversies. Hamilton's Bank of New York, founded in 1784, became a key player on Wall Street. The building stood near Pearl and Wall Streets, serving as a hub for both banking and stock trading. Under Hamilton's influence, Wall Street moved from informal bartering to structured finance. The paper economy was born, where fortunes could rise or fall based on signatures and promises rather than ships or gold. By the early 1800s, Wall Street was expanding rapidly. The NYSE moved from coffee houses to rented rooms, growing in both membership and influence. Yet trust remained fragile. There were no strict regulations. Rumors could spark chaos in minutes. A single lie could ruin investors. One such incident came in 1792, shortly after the Buttonwood Agreement. William Duer, a former assistant to Hamilton, began speculating on government bonds with borrowed money. He believed he could manipulate the market for personal gain. When his scheme collapsed, prices plummeted. The public panicked, and the young American financial system trembled. Duer was sent to debtor's prison, and Wall Street's first financial crisis had begun.
This event taught the traders a painful lesson. Speculation without restraint could destroy trust faster than any war. Yet it didn't stop future risk-takers. If anything, it revealed how powerful the market could be. During the War of 1812, trade with Britain collapsed, and American ports suffered. The economy weakened, but Wall Street endured. Merchants and bankers began investing in domestic industries, manufacturing, textiles, and transport. It was during this time that New York began to surpass Philadelphia as the nation's financial center. The war also highlighted another truth. Wall Street's strength depended not only on peace or prosperity, but on adaptation. When trade halted, finance found new paths. When ships stopped,
Bonds and shares still moved. Money had become its own form of power. In 1825, the completion of the Erie Canal changed everything. The canal linked the Atlantic Ocean to the Great Lakes, turning New York City into the main gateway for goods moving through the country. As trade expanded, so did the need for financing. Wall Street provided that lifeline. Banks issued loans for canal projects, railroads, and early factories. Investors poured money into ventures that promised new wealth. Brokers worked tirelessly, trading certificates for canals, land, and new businesses. By the 1830s, Wall Street was more than a street. It was a network of people and institutions driving America's economic growth. Then came another fall. The Panic of 1837 began with the collapse of banks that had issued risky loans and unsupported paper money. President Andrew Jackson's decision to dismantle the Second Bank of the United States also shook confidence. Within months, credit vanished, prices dropped, and businesses failed. Crowds gathered on Wall Street, shouting for answers. Merchants who had been wealthy weeks before now faced ruin. The crisis revealed both the strength and the weakness of the system. Wall Street could lift people to fortune, but it could also bring them down in a heartbeat. The street became a mirror of the nation's dreams and its fears, a place where progress and panic walked side by side. In the 1850s, the railroad industry ignited a new financial revolution. Rails were spreading across the country, connecting cities and creating new markets. Every mile of track required money, and Wall Street supplied it. Stocks in railroad companies became the most traded assets. Wealth poured in, and fortunes grew overnight. But once again, greed followed. Some companies exaggerated profits, others sold fake shares. Speculators manipulated prices, spreading rumors to raise or crash values. Wall Street was becoming famous not only for wealth, but for deceit. Still, the railroad boom transformed America. It turned distant towns into centers of commerce and gave rise to new industries. The flow of money through Wall Street had begun to shape the entire nation. By 1860, Wall Street had changed beyond recognition from its colonial beginnings. The wooden wall was long gone. In its place stood stone buildings filled with clerks, traders, and bankers. The air was thick with the sound of quills scratching paper, horse-drawn carts delivering messages, and men debating over prices. The New York Stock Exchange had grown powerful, its members proud of the order they had built. But behind that order, tension brewed. Wealth was growing faster than fairness. Information was power, and those who had it ruled. Many Americans admired Wall Street's success, but distrusted its motives. They saw the street as both the symbol of progress and the source of corruption. As the 1850s closed, the United States stood on the edge of civil conflict. The issue of slavery divided the nation, and its economic effects reached Wall Street too. Northern bankers funded industry, while Southern wealth came from plantations. When talk of war spread, investors worried about the future. Yet few understood how deeply that war would test the financial world. The next decade would change not just politics, but the very foundations of money in America. Wall Street, born from a simple trade under a tree, was about to face its greatest trial.
The year 1860 opened with uncertainty. The air across the nation felt heavy with tension. South and North stood apart, not only in belief, but in economy. On Wall Street, traders whispered about the unthinkable: war. No one knew what it would mean for the markets, or for the young financial system that had grown out of Hamilton's vision. But they would soon find out. The Civil War would test the limits of money, trust, and power in ways no one could imagine. When the first shots were fired in 1861, the nation was unprepared not just militarily, but financially. The federal government faced a crisis.
how to pay for war. Taxes alone couldn't meet the cost. The Treasury began to issue war bonds, and Wall Street became the battlefield of finance. Bankers, brokers, and citizens alike bought these bonds, believing it was both duty and opportunity. In 1862, the government introduced a new form of currency, greenbacks. They were paper money, not backed by gold or silver, only by faith in the United States. It was a bold move, and many doubted it would hold. Yet the war forced innovation, and Wall Street adapted. Brokers traded greenbacks daily, their value rising and falling with the fortunes of the Union Army. For the first time, Wall Street was directly tied to the nation's survival. The fate of the Union was reflected in the market. When Northern armies won battles, prices rose. When they lost, fear took hold. The street that once traded furs and bonds was now trading the future of America itself. One man stood at the center of this transformation, Jay Cooke, a Philadelphia banker who became the financial backbone of the Union. He organized a massive campaign to sell war bonds, reaching everyday Americans. His success helped fund the Northern War effort and established a new connection between government finance and public investment. Wall Street watched and learned. Cooke had shown that selling bonds wasn't just a government duty, it was a business. The idea that the public could be drawn into national finance through persuasion and trust would shape the future of American markets. When the war ended in 1865, the country was battered but alive. The financial system had survived, and Wall Street had gained power beyond measure. But that power came with new temptations. The years after the Civil War brought an era of expansion. The country was rebuilding, and the railroads were leading the way. Steel tracks stretched from coast to coast, opening new lands, cities, and industries. Behind these railroads stood Wall Street. Investors poured their savings into railway stocks. Financiers floated massive loans to fund new routes. Fortunes were made in weeks. The nation's wealth shifted from farms to paper assets, and a new class of financial titans emerged. Cornelius Vanderbilt, Jay Gould, Jim Fisk, and Daniel Drew. These men controlled railroads, banks, and markets through daring, sometimes ruthless strategies. They were admired for their success and feared for their greed. Their manipulations became legendary. Jay Gould and Jim Fisk set out to corner the gold market. They believed that by buying large amounts of gold and convincing the government not to sell, they could drive prices sky high. To achieve this, they built political ties, including with President Ulysses S. Grant's inner circle. As gold prices soared, panic spread. Importers and merchants couldn't afford to buy foreign goods. The economy teetered on the edge. On September 24, 1869, a day known forever as Black Friday, the U.S. Treasury intervened, selling millions in gold to stop the manipulation. Prices crashed. Fortunes disappeared in hours. The scandal exposed the dark side of Wall Street's growing power. The market could be bent, twisted, and broken by a handful of men. It revealed how easily greed could outpace ethics and how deeply politics and finance had become entwined. Just 4 years later, another disaster struck, the Panic of 1873. It began with the collapse of Jay Cooke's banking firm. Cooke had invested heavily in railroads that were failing to make profits. When his firm couldn't pay its debts, panic swept through the financial system. Banks failed, factories closed, the nation entered what would be called the Long Depression, lasting nearly 6 years.
On Wall Street, crowds gathered again. Police were stationed to control the chaos. The stock exchange shut down for 10 days, the first time in its history. Many blamed overspeculation and corruption. The dream of endless growth had turned into fear. The crisis changed the nation's view of finance. It reminded Americans that wealth built on unstable ground could collapse overnight. Yet even then, the lure of profit
never faded. When the markets reopened, trading resumed, and new investors stepped forward. As the 19th century neared its close, new figures rose to dominate Wall Street, men whose names still echo in history. J.P. Morgan, Andrew Carnegie, and John D. Rockefeller became symbols of power and ambition. They built industries, merged companies, and controlled banks that reached across the nation. J.P. Morgan, in particular, became Wall Street's most influential figure. Calm, calculating, and commanding, he acted as both banker and statesman. He reorganized railroads, stabilized failing banks, and financed the growth of American industry. His firm, J.P. Morgan and Company, became the heart of American finance. Yet this new power also sparked fear and anger. The public saw Wall Street as a closed circle of wealthy men deciding the fate of the economy. The word trust began to carry a double meaning, both confidence and control. When a few held the power to move markets, democracy itself felt uncertain. Outside the marble offices of bankers, life for the working class was hard. Factories paid low wages. Labor strikes erupted across the country. The Great Railroad Strike of 1877 spread from West Virginia to major cities, halting trains and sparking violence. Soldiers were sent to restore order. Behind every strike, there was the shadow of Wall Street, the unseen force that controlled wages, prices, and credit. While financiers built mansions, workers struggled for bread. The gap between the street's wealth and the nation's poverty grew wider. Newspapers began to call Wall Street the temple of greed. Some politicians demanded reform, but few dared to challenge the financial giants directly. In 1893, another crash struck the economy. Railroad overbuilding, falling silver prices, and reckless speculation caused panic. Banks closed by the hundreds. Unemployment spread. Crowds once again flooded Wall Street, demanding answers that never came. J.P. Morgan stepped forward again, lending the government $65 million in gold to stabilize the treasury. His action restored order, but it also confirmed his dominance. A private banker had saved the nation, a fact that both impressed and terrified Americans. Wall Street was no longer just a place. It had become a power greater than government itself. By the end of the 19th century, Wall Street had transformed completely. The Buttonwood tree and simple agreements of the past were distant memories. Now, vast corporations ruled, and millions of shares changed hands each day. Telephones and ticker tapes replaced handshakes and ledgers. Information moved faster, and fortunes shifted in seconds. The culture of speculation was stronger than ever. Risk was no longer feared, it was celebrated. Success was measured in profits, not principles. Yet beneath the glittering surface, cracks remained. Corruption, inequality, and manipulation had become part of the system. Wall Street had built America's growth, but it had also built resentment that one day would demand reckoning. By the dawn of the 20th century, Wall Street had grown into a colossus. The streets were lined with stone buildings, their marble columns signaling permanence and power. The click of ticker tapes and the roar of brokers filled the air. Electricity had replaced gas lamps, and telegraphs connected Wall Street to the far corners of the globe. This was the age of ambition at its highest, and the street was both its stage and its prize. At the center of this era stood J.P. Morgan, whose influence extended far beyond the boundaries of New York. Morgan was no ordinary banker. He reorganized railroads, stabilized failing banks, and orchestrated mergers that created industrial giants. His work reshaped the nation's financial landscape, giving it structure and scale. Yet with power came unease. Many feared that a single man controlling such vast sums could dominate the economy. Critics argued that Wall Street's giants were above the law. Morgan's ability to influence the government, markets, and even the economy itself earned him both admiration and suspicion. The public began to understand that Wall Street was no longer merely a marketplace. It was a seat of unseen authority. The early 1900s were marked by rapid industrial expansion. Steel, oil, and electricity were transforming cities and lives. Wall Street financed these ventures, providing the capital to build factories, railroads, and power plants. Investors were drawn to the promise of wealth, and the stock market flourished. New tools and techniques magnified this growth. Brokerage houses offered more credit, allowing investors to borrow money to buy shares. This practice, known as buying on margin, amplified profits and risks alike. A rising market could make fortunes in months, but a falling one could erase them just as fast. By the 1920s, optimism had reached fever pitch. Americans from all walks of life joined the market. Banks encouraged savings to flow into stocks. Wall Street became a symbol of opportunity, and the dream of easy wealth captivated the nation. The decade of the 1920s brought prosperity, but it also brought reckless speculation. Stock prices soared, driven by public excitement rather than underlying value. Small investors, eager to profit, bought shares on margin, sometimes investing 10 times what they actually owned. Corporate profits were highlighted in newspapers, while risks were often ignored. Analysts praised growth without warning of potential collapse. Wall Street had become a spectacle, celebrated in headlines, parties, and advertisements. Yet beneath the glamour, foundations were unstable. Even experienced financiers were not immune to excess. Many overlooked warning signs, believing that the market's upward climb would never end. Confidence, once a stabilizing force, had turned into complacency. The tools that had once built wealth, credit, speculation, and trust, were now amplifying danger. During this era, Wall Street was a theater of ambition and emotion. Brokers shouted orders, ticker tapes rattled endlessly, and traders moved with urgent energy. The human cost was intense. Jobs, savings, and reputations depended on split-second decisions. Families watched fortunes grow and vanish overnight. Stories of sudden ruin and unexpected gains circulated constantly, reinforcing the street's mythic status. Among the notable figures of this time was Charles E. Mitchell, president of National City Bank. Mitchell encouraged ordinary Americans to invest, helping to expand the market's reach. But his aggressive promotion of credit and speculation contributed to the instability that would follow. Wall Street had empowered both dreams and disaster. Despite the apparent prosperity, warning signs were emerging. Corporate earnings were often inflated, and the practice of borrowing to buy stocks left investors vulnerable. Analysts noticed that stock prices no longer reflected actual business performance. Many insiders knew the market was overheated, but few acted decisively. Political leaders debated regulation, yet the prevailing belief was that markets should govern themselves. Public trust in Wall Street remained high, masking the growing fragility. It was a calm before the storm, an era of brilliant triumph overshadowed by looming collapse. By the late 1920s, the stock market had become a symbol of American wealth and modernity. Brokers were celebrities, financial reports were front-page news, and investing was considered a path to social mobility. Wall Street had achieved unparalleled influence over national and international finance. Yet the very mechanisms that had fueled growth, credit, speculation, and mass investment, now threatened disaster. Prices were unsustainable. Confidence, once a stabilizing force, had become a fragile illusion. The financial system was exposed to shocks that could cascade with devastating speed. Few fully grasped the scale of the risk. It was a lesson in human psychology as much as finance. Fear and greed, optimism and panic intertwined to shape the market's future. Wall Street, the engine of national growth, was approaching its ultimate test. As the decade drew to a close, every signal pointed to tension. Analysts debated market stability.
Insiders quietly adjusted holdings. Ordinary investors, swept up in excitement, ignored caution. Brokers shouted over trading floors. Their voices reflected both triumph and anxiety. The scene was electric, vibrant, and dangerous. The final months of 1929 would soon turn that energy into catastrophe. Wall Street's human drama, its ambition, and its unchecked power were reaching the breaking point. Wall Street entered October 1929 with confidence at its peak. The roaring decade had built skyscrapers, fortunes, and national pride. Brokers shouted orders across crowded floors, ticker tapes streamed numbers in a continuous rhythm, and investors across the country watched as wealth seemed to rise endlessly. Yet beneath this glittering surface, cracks had widened. When the collapse came, it was swift, dramatic, and unforgettable.
On October 24, 1929, a Thursday, panic first struck. Prices that had climbed endlessly began to drop. Investors rushed to sell. Brokers struggled to meet demand. On the trading floor, chaos erupted. Orders piled up faster than they could be executed. Wall Street, the engine of American wealth, sputtered. Banks and large investors attempted to stabilize the market. They purchased massive amounts of stock in hopes of restoring confidence. For a moment, it seemed the crisis could be contained, but the optimism was temporary. By Monday, October 28th, Black Monday, the market plunged again. On Black Tuesday, October 29th, the collapse became catastrophic. Billions in paper wealth vanished in a single day. The human impact was immediate and devastating. Ordinary families who had invested their savings lost everything. Brokers and bankers faced ruin. Confidence in the financial system collapsed alongside stock prices. The reality of unchecked speculation and over-leveraged investments had arrived. The crash triggered the Great Depression, a period of widespread poverty, unemployment, and despair. Factories closed, banks failed, and breadlines formed. Wall Street, once a symbol of opportunity, became a symbol of vulnerability and excess. People who had believed in the promise of the market were now forced to confront its fragility. Families lost homes, farmers lost land, and workers lost jobs. The psychological impact was profound. Fear replaced optimism. Trust in financial institutions eroded. The moral question arose: had Wall Street's pursuit of wealth placed private gain above the public good? The collapse forced the government to act. President Herbert Hoover's initial measures were limited, aiming to restore confidence. Yet the scale of the crisis required broader intervention. When Franklin D. Roosevelt became president in 1933, sweeping reforms transformed finance in the United States. The Securities Act of 1933 and the Securities Exchange Act of 1934 created regulations to protect investors. The Securities and Exchange Commission, SEC, was established to monitor trading and enforce transparency. Banking reforms, including the Glass-Steagall Act, separated commercial and investment banking to prevent conflicts of interest. These measures reshaped Wall Street permanently. No longer could speculation operate unchecked. Markets had rules, oversight, and accountability. The human and financial costs of 1929 and the Great Depression forced the nation to reconsider the balance between opportunity and protection. Through the 1930s and into the 1940s, Wall Street slowly rebuilt. Trading returned, banks stabilized, and confidence began to grow. However, the memory of collapse remained. Investors were more cautious, regulators more vigilant, and the public more aware of the risks of unchecked speculation. Financial giants, too, adapted. Figures like J.P. Morgan had already established strong institutions that survived crises. Wall Street retained its influence, but lessons had been learned. Power without responsibility can destroy both wealth and trust. The aftermath of the crash changed not only finance, but culture. Stories of hardship, resilience, and recovery filled newspapers and literature. Wall Street became a cautionary tale, a place where ambition could achieve greatness, but also where excess could devastate a nation. This period also fostered innovation. Investment strategies became more sophisticated. Financial education grew. Institutions built safeguards against collapse. Wall Street's identity evolved from an unchecked engine of speculation to a complex, regulated system balancing risk and reward. By the 1950s, Wall Street had emerged from the shadows of disaster. The street that had begun under a wooden wall, grown through ambition, scandal, and triumph, had survived its greatest test. It had fueled wars, expansion, and industrialization. It had built empires and destroyed fortunes. It had created both opportunity and inequality.